Okay, the next topic is accounting for bonds and non-current liabilities. So let us first discuss briefly what are bonds. What are bonds? We have been coming across this terminology, what basically they are. Bonds are long-term debt financing for corporations and governments. If the government or some big corporation, they need to raise money, either they can issue shares, common stock, or they can issue bonds. So what is basically a bond? Let's say there are two parties, A and B. A happens to be a corporation or a government body. It needs money. So this entity issues bonds to investors. Investor invests in these bonds, they buy these bonds, and in return, the issuer A will give some periodic payments called coupon payments, also called the interest payment, for a specific period of time. And when the time is over, the bond is then taken back and the money is given in full back to the investor. So this is it's all about. So basically, it's a contractual obligation where the issuer, though the company or the corporation or the government body that issues the bond, it pays a certain amount of money that is called coupon, and this money is paid to the holder, the investor. The money that is paid at a certain rate. That rate is called the stated rate or the coupon rate. And when the bond matures, 5 years, 10 years, 15 years, there are some bonds in the US, they have maturity up to 30 years, right? And after that time, the face amount, also called the nominal amount, it is paid back to the initial investors. Just a minute. So the investors, they must be familiar with regarding their rights, their responsibilities when they buy bonds. So all these terms, the rights and responsibilities of the issuer as well as the investors, they are listed down in an agreement called the bond indenture. Remember, bonds is a topic that is discussed in detail in your section B, corporate finance, CMA part 2. So here you just have to have a basic understanding. So issuing bond is quite an expensive activity. It is quite extensive and expensive process. It requires a lot of legal work, a lot of accounting work. That is why if you need money for a longer period, 10 years, 5 years, 15 years, only then you should issue bonds. Otherwise, if you need money for the short term, go for running finance, a revolving line of credit. There are many tools you will learn in your CMA part 2. So bonds are for the long term. And one important point that you must remember, that longer the term of the bond, a 5-year bond will carry interest rate of 3%, for example. A 10 years bond will carry a higher rate, let's say maybe 7%, because if the duration of the bond is long, the investor is taking more risk, so he must be compensated in the form of higher return. Okay, so we have a question here. All right, so let's go through some categories of bonds. They have been segregated from maturity pattern, valuation basis, term, and so on, so on. So on maturity pattern basis, the bond that is issued for a specific period, for 10 years, 5 years, it's called a term bond. And a bond that is redeemed in pieces, like maybe 10% of the bond is the amount is paid in maybe first year, 30% is paid in the second year, maybe in the remaining 70% or 60% is paid in the 5th year. So the bond that matures in pieces, such a bond is called a serial bond. But a bond that that matures in a specific point in time, a single date, that's called a term bond. Then from valuation point of view, the bond that is the price of which is dependent upon the market conditions, such a bond is called the variable rate bond. The price depends upon the market conditions. And there is a very interesting type of bond called the zero coupon bond. This bond carries no interest. Like, why would I invest in such a bond when it carries no interest? This bond would be issued at a deep discount. A bond that has a par value of $100, also called the face value, it will be issued at a deep discount of, let's say, $70. So a bond that has a face value of 100 is sold at $70. This $30 difference is called the discount, deep discount. So when I buy a bond at $70, after 5 years, I get back $100. Effectively, I didn't receive any interest, but over the period, this $30, I receive extra at maturity. This effectively is my interest. So such a bond is called zero coupon or deep discount bonds because they bear no stated rate. The difference between the price you pay and what you get at maturity, the difference is in fact your interest income. Then there are some bonds that are backed by some commodity like gold, sugar, or any other commodity. So such bonds are called the commodity bonds. Then there are other types of bonds depending upon the redemption provision. The bonds that are callable by the issuer, like I'm the issuer and I have an issue a bond with the firm with a 5 years term. And since it's a callable bond, I can call this bond back maybe in the third year. Callable bonds are the bonds that can be called back even before maturity. And you know that when you buy these bonds, you know them that they are the callable bonds and the issuer can call them back even before maturity. And then there are convertible bonds. These are the bonds that will be converted into specific numbers of shares in the future. Then the fourth categorization is with regard to securitization. Bonds are backed by certain asset. If your bond is backed by a real estate asset like property, plant, it's called a mortgage bond. If there is no collateral at all, nothing, just the general credit of the business, good name, such a bond is called debenture. Remember, debentures are bonds, but they are not backed by any asset. Then any bond that is guaranteed by a third party, like a parent for a subsidiary, such a bond is called a guarantee bond. Then if there are some financial assets, bonds issued on the basis of some existing investments in bonds, some stocks, and some other financial assets, these are used as collateral. Such bonds are called collateral trust bonds. These stocks, bonds, they are given to a trustee, maybe a banker. Then these bonds are issued. If there is a default, then these bonds and stocks which are placed with the trustee, they are sold and the amount is paid back to the investors. Then if there are some movable properties, remember real estate bonds are mortgage bonds, and if the property is movable like railroads, airplanes, rail cars, such bonds are called the equipment trust bond. Then we have another categorization, the fifth categorization, ownership wise. If the bonds are registered for a specific person, only that person can receive interest. Such bonds are called registered bonds. And those bonds where the ownership is not mentioned, they are bearer bonds. Anyone who holds those bonds, he or she will get the interest. Then the next categorization is priority. Some bonds are preferred over the other. Like, for example, if I have this piece of property and I've issued certain bonds where I use this land as a security, it's a mortgage bond, right? Let's say the value of this property is 10 million, 100 million, and the bond issue is just 10 million, which means 90 million of this collateral is still underutilized. I can then issue another bond on the same property. The first bond is the one that is considered as prior, means if any default, the asset will be disposed and the amount will be paid first to these bondholders. And if any money is left, then it is paid to the bonds that falls below in the hierarchy. These are called the subordinated mortgage bonds. Similarly, right? So if we have the debentures issued, they are prior in hierarchy. If you issue another debenture, the class of debenture that is called the subordinated debenture, like first mortgage debentures, 10 million. And when you use the same collateral and issue another tranche of mortgage, this is called the second mortgage bonds. So it's just that one is called senior, other is called junior. This is for the purpose of if there is default. So ranking is important. Then repayment provision. Interest is to be paid on bonds, but some bonds, they are different than the normal bonds, because income bonds are the bonds that will pay interest only if the issuer, the company that has issued the bonds, if that company earns profit, only interest is payable. If there is no profitability, mafi interest. That's why these bonds are riskier. So they will definitely carry a higher stated rate, or what you call the higher coupon rate. And then finally, the revenue bonds. Revenue bonds, these are the bonds issued by the governmental units like Pak Railways or Vasa, Vabda. These bonds will pay interest from some specific revenue sources, like the companies that I've told you, public corporations. So just go through them briefly. Just need to know various types of bonds. Now, the next issue is bond valuation. This is something that we do in detail in CMA Part 2. Right now, you need to learn how do we value bond, just basics. Remember, I told you bond will have a certain face value, also called the par value, or also called the nominal value. Mostly it is $1,000 in the US. Face value, par value, or nominal value, right? The rate that you offer is called the stated rate, 8%, for example. The date at which you issued the bond, at that date, there will be some prevalent market rate for similar bonds. That rate might be 10%, or that rate might be maybe 5%, right? So remember, on the date of your issue, your stated rate, it could be more than the prevalent market rate of comparable bond, or it could be less than the prevalent rate. Now, the important point is, how do we value the bond? Bond valuation is basically equal to the present value of the interest payments that we will make in the next 5 years. Let's say this is a term bond with 5 years maturity. I will make 5 yearly payments of interest, and at the 5th year, I will pay the full amount back, $1,000. Now, if we can calculate the present value, the value of the bond, let me write down the formula. This is just a quick review because this is the area discussed in detail in CMA Part 2. Value of the bond is equal to present value of interest, 5 interest payments on year 1, 2, 3, 4, 5, plus the present value of the original principal, present value of the principal. So if you can discount the 5 interest payments and the principal payment to be made at the end of 5 years, if we can calculate their present value, this will be the value of the bond. Just you need to keep this in mind. Value of the bond is the present value of the interest payments and the present value of the principal. Just keep that in mind and just slightly go through the text, and that should be sufficient. Now let us discuss bonds can be issued in 3 situations. Your bond issued at par, issued at discount, issued at premium. I just told you, when your offered rate is 8%, that's called the stated rate. And at that time, the prevalent market rate is also 8%. Your bond will sell exactly at the face value. $1,000 bond will bring you exactly $1,000 because your rate and the prevalent market rate is the same. So the bond will get you exactly $1,000. But if your stated rate is 8%, but the prevalent market rate at that particular point in time is 10%, you're offering less rate, less coupon rate, less stated rate. So your bond will sell at a lower price. It will sell maybe at $921, whereas the par is $1,000. Your people will pay less because you're offering less rate. That's why your bond will sell at a lower value. Now, if the stated rate is 8%, and at that point when you issued the bond, the prevalent market rate on similar bond was just 5%. Now look at this. You are paying a higher rate than the market rate. At that point when the bonds were issued, your bond will sell at a premium. It will sell at, let's say, $1,060. Right? How do we calculate these numbers? This is beyond the scope of your CMA Part 2. I just want to show you some calculations. Let's say FTC Incorporated issued 1,000 face value of 5-year bond on 1st January 2021, when the market interest rates on the bond risk in terms of 5%. And the bond pays 5% interest annually. The market rate was 5% on the date of issue, and I'm also paying 5% interest. Since my stated rate is the same as the prevalent market rate, my bond will exactly sell at $100,000. So my face value and the cash I collect would be the same. So this is how I amortize the bond. This is how the bond is shown. I will show you all the calculations. So the opening carrying values, I received $100,000. Interest expense and interest paid is the same. Why? Because my face value of the bond and the amount I collected is the same. Why? Because the market rate and the stated rate are the same. Now listen to me very carefully. How do we calculate interest payment? How do we calculate the interest expense? This is something important you need to know. Interest payment is based upon the bond par multiplied by the stated rate. Remember, the bond par value, face value, nominal value multiplied by the stated rate. 5,000, 5,000, 5,000. Every year, 5,000. Interest payment is fixed. It's always the same because it's simply because the face value stays the same, your coupon stays the same, so it's 5,000 every year. Then what about the interest expense? Interest expense is the opening carrying value multiplied by the market rate. Interestingly, that happens to be 5%. So that is the reason your interest payment par time 5% and your interest expense 100,000 times 5%, it's the same. So there is no amortization because there is no discount, no premium. So when such a bond is issued, what journal entries do we make? When we issue the bonds, we will receive $100,000 cash, and the bond payable will show exactly $100,000, which is the par or the face value or the nominal value. At the end of the first year, we pay 5,000 interest, and at the same time, we charge 5,000 expense to our income statement. So the entry that we make is we debit interest expense 5,000 and cash 5,000. Expense and the interest payment, they're exactly the same. This is the entry at the end of year 1, same entry at the end of year 2, same 3, 4, 5. But at the end of year 5, since you now have to redeem the bond, at the end of year 5, you will make 2 payments. First, you will pay the interest 5,000, and you will also have to repay this entire principal. You debit the bond payable and you credit 1 of 5,000. So this represents 100,000 par and remaining 5,000 interest. Ji Ahmed, wa alaikum assalam wa rahmatullah. Now let's move on to the next one. Bond issued at discount. Under what circumstances it will happen? When your stated rate is 5%, whereas the prevalent rate, the market interest rate on bonds of comparable risk and term is 8%. You are issuing a bond at 5%. Similar bonds are issued at 8%. You are offering a lower rate. Hence, your bond will sell at a discount. How this amount is calculated, you will learn in part 2 using these keys. These are the specific time value of money keys used in the financial calculator. We'll do it inshallah in part 2. So your rate is lower than the comparable rate being offered in the market. So your bond will sell at a discount. Your bond will get you 88,021. What entry you will make? You will debit cash or bank 88,021. You will credit the bond payable 100,000. This difference between what you paid and the liability which you will settle after 5 years, this difference is called the bond discount. Mind the word, this is called bond discount, right? Because you received 88,021 instead of 100. So this bond discount will be amortized at the end of every year through a certain entry. I told you the interest payment would be the same, 5,000, 5,000, 5,000. Why? Because the face value is the same and the stated rate is the same. But your interest expense is different. Interest expense is the bond carrying value multiplied by the market rate, the comparable market rate. So 88,000 times 8%, that gives you 7,041. Now, gentlemen, listen to me very carefully, very, very carefully. This is the interest you paid. This is the interest expense you charge in your income statement. The difference between what you have charged to income statement and what you have actually paid, this difference is called the discount amortization. Because at the end of the 5th year, we won't be paying back 88,021. We will be paying the full amount of $100,000. So Shoya, this discount, which we recorded earlier, the total amount was 11,978. This will be eliminated and it will become 0 at the end of the 5th year. So this is how it happens. The difference between your interest expense and interest paid, this 20,040 or 2041, this will be added to the carrying value. Your new carrying value is 90,063. This is the entry we make at the end of the 1st year. Interest expense is debit. Bond discount is being amortized by 2041 and the cash payment is 5,000. So this is the amount that will be added or that will increase the carrying value from 88 to 90,000. What happens in the next year? Next year, the interest payment is based upon the face value times stated rate, but the interest expense will be the carrying values times 5%, 7,205. Again, the difference between the expense and the interest payment is called the discount amortization, 2,205. Entry, debit interest expense, credit discount amortized, and credit cash 5,000. So you see this amount 2205 will increase the carrying value from 92. This will keep on happening every year. 23, then in the end of 4 year, 2572. By the end of the 5th year, your carrying or closing value will keep on increasing. By the time the bond matures, the amount will be fully restored to $100,000. And at the end of the 5th year, this is the entry you make. You debit the expense, You debit the bond payable to remove it from your books of accounts. You amortize the remaining discount and you pay the interest as well as the principal at the end of the 5th year. Now, the third type, bond issued at premium. Now, in this case, I'm offering 8% rate called the coupon rate or the stated rate, which is higher than the prevalent rate in the market of similar bonds. Since my rate is higher, my bond will sell at a higher price. And what is the higher price? How is it calculated? Not the subject of CMA Part 1. Just believe that it is 112,988. I will share with you the video relating to bond valuation from CFA lectures that I've recorded earlier. So this is the amount that you will receive. Why people will pay you more? Because you are offering a higher rate. This is what you have received from your customer, but from your investors. But at the end of the 5th year, you will pay them back 100,000. So what will happen? Just like if you go back, this was the carrying value which kept on increasing with the passage of time and became 100,000 at the 5th year, from 88 to 100,000. This bond is a premium bond. By the time it matures, the 112 amount will fall to $100,000. So what entry do we make when the bonds are issued? We debit the cash 112,988. We credit the bonds payable and we credit the bond premium 12988. This is what you show here. Again, your interest payment is based upon the face value times the stated rate. That is the same all the years. But your interest expense is calculated by taking the opening carrying value and multiplying it with the prevalent rate. This is the interest expense. Difference between what you charge and what you pay is the premium amortization. 5649.42 less 8,000 is negative. So this negative will be added here and the balance will fall to 110. So the entry that we make at the end of the 1st year, this is the interest expense. This is the premium amortized and the interest payment is 8,000. Same entry in the 2nd year, interest expense, bond premium amortized, interest paid. Same in the 3rd year, interest expense, premium amortized, and the interest payment. Same in the 4th year, interest expense 5278, 2721 is the premium amortization, interest payment 8,000. At the end of the 5th year, this is going to be your interest expense. This is the premium amortization. Now, eventually, you will have to pay this back $100,000 together with this 8,000 interest. So the total cash payment is 108, principal 1,000, remaining 8,000 is the interest payment. All right, so this is how we do the relevant accounting. Now we have some non-current notes payable. Remember, the title is bonds. We have discussed various types of bonds. We have seen some accounting entries for discounted bonds, premium bonds, and the bonds issued at par. Now there are non-current notes payable. There are 3 types of notes payable. Let us discuss them through example. This note payable requires just a single payment at the end of maturity. Some notes, what are notes basically? Let's say an entity agrees to give in return for merchandise a 3-year note. I buy goods from you, Subhan,